Yep.
Okay. Okay, we are going live. I am Ryan Dunstan with East Main Street Insurance, and I have Chris Kamara here with Kamara Insurance Services. We are pledging to come to you every Thursday at 2 o'clock and wanting to bring you information, homeowners, auto insurance, business owners insurance, wanting to help be that broker's ear that you've been wanting to ask a question on, and we are here to answer them. Today's podcast or informational piece, we wanted to bring up homeowners. It's kind of a big topic right now. Everyone is shopping for insurance, buying for insurance, and we had found some great data that we wanted to bring out to you. It's 14 questions that every homeowner should ask about their insurance policy. And we've got quite a bit of, we want to go over those questions with you in detail, help you understand maybe what they are and what you should be looking out for whenever you're purchasing homeowners insurance. I know Chris has some topics as well that he's had some of his clients come up and say, hey, have you seen these rates? Have you heard of this company? So
You want to accept that share right there? And we'll start with that.
Yeah, let me accept this share screen. So there's us, beautiful home.
Perfect. So just for housekeeping purposes, this is how we want it to show up. Me and Ryan, and then we'll put all the slides up, and then we can field any questions or go over anything anyone wants. I like that look right there.
Okay.
Unless you can move it to the other side so that the logo's not blocked, but doesn't matter to me too much.
We could do that.
No. There you go. That's fine. I'll have to fix it. Cool. So the 14 questions, I guess we should start there. Let me back up real quick, though. So
yeah, please do.
Let's explain to the audience what this is about. So house calls is just like if Ryan and I were sitting in a coffee shop or we're sitting someplace and anyone can drop in at any point in time and ask their insurance questions, and we're going to answer it live. Our goal and our commitment is to be here every Thursday from 2 p.m. to 3 p.m. to answer questions, to provide relevant insurance-related information, developing things politically, questions we're seeing in both of our agencies from our clients, and give the best content we can for that. That's the purpose of House Calls. This podcast goes live on both East Main Street, their Facebook page, Kamara Insurance Agency's Facebook page, Kamara Insurance Agency's YouTube. So you can ask your question on Facebook or YouTube. You don't have to even be on here at all or have your voice on at all. You can type in a question. We'll get to that. And then Brian's also working on getting his YouTube channel up and working. So there'll be 4 ways you can ask a question of us anytime you want, Thursdays from 2 to 3.
And we want to just put it out there too. You can message us, whether it be on our Facebook page or, anything, even after watching the video, we're checking these for comments. We can see those. So we're more than welcome to, take your question that you've posted and bring it up and get it answered for you. Obviously, we want to use it as content on our page, but we'll message it back to you so that way you get your question answered if you don't have a chance to hop back on our video at 2 o'clock on Thursdays.
Great. So yeah, if you want to just start, I'll start pulling up some slides. I just need a moment here.
Yeah.
My computer's not cooperating, but if you want to start on the first question, I hope to have slides ready for you in just a few minutes.
Okay, definitely. So the first question that was vital that we found out would be, will this policy be adequate if I have a total or large loss? Basically, will it cover the cost of rebuilding my home to its pre-loss condition, including demolition, debris removal, replacement costs, foundation, current building standard codes, which essentially just starts to go back to the beginning part of a policy, which is coverage A. What is coverage A? what does that entail? What does it mean? Why is it just a letter? So coverage A is your dwelling cost. That's the top line on any insurance policy. That is going to be the framework to rebuild your home. That's kind of a starting point or a basis point of what your coverage level should be. And it's really a helpful tool, because if you do go out and you're shopping around, that's going to vary wildly. Some people may give you coverage A at 500,000 or 700,000 or 300,000. So really just dialing in with what that coverage amount is, and then maybe using that same coverage limit whenever you do approach another broker.
And ask why the difference. I mean,
ask why
question, right?
Yep. Yeah, and you see that too whenever you got new homeowners. What's something that you've seen, Chris?
Yeah, the thing that we pointed out recently, as recent as this morning, is we pointed out that they have a quote that's more competitive by a couple $100 until you look at it, and the deductible is a 1% deductible, which was close to $10,000. Our deductible was $2,500. So you're not comparing apples to apples, and you're not getting the coverages you really think you're getting.
Yeah. Apples to apples is huge. Obviously carriers are going to vary, and that's where some of the rates we can't control, because each carrier is going to file a different rate. But knowing that you at least have a starting basis point at coverage A, because that's huge.
Yep, absolutely. Sorry, I'm almost done with these slides.
No, that's great. Go
to the second one. We'll keep.
The next question was, what causes of loss are not covered? So that is another huge kind of pain point, I think, that a lot of clients are starting to understand, because of the whole, fire issue, people not understanding what perils, and that's what we call it here in the industry, is a peril. Mm-hmm. What's covered, what's not covered.
And perils are things like fire, water, wind, right?
Yeah. A standard policy is going to have your fire, your smoke, your internal explosion, your windstorm, your hail, vandalism is huge. Theft is huge. Water damage, falling objects. So those are things that are perils. Those are in your typical policies, and perils is what you want to ask for, especially, if we're coming up into the wildfire season and people are just shopping and having to be placed with California FAIR Plan. So, FAIR Plan.
And that's a kind of weird thing. The FAIR Plan in and of itself is not a common policy.
Yeah.
It's something that was created to be different, right? So, sorry.
Yeah, it's got separate type of perils that are excluded in it. So making sure what's excluded in the FAIR Plan, if you have to go that route, and then what's included in the supplemental policy, usually like an Aegis or a Bamboo,
and that supplemental policy goes by many names. People use many names, right? Yeah. There's the DIC or companion or wrap or supplemental. They've been used interchangeably, and some of them are misnomers, but they definitely are used. So
talk with your agent and understand which policy is going to cover which. Peril is the big thing. I was looking at the next question. What discounts do you offer, and how do I qualify for them? So cool.
Keep going.
That's going to be wildly interchangeable. Each carrier is going to have different discounts, whether it be multi-policy discount. Maybe it's a new purchase. They give you a lot of carriers will give you a new purchase discount. Yep. Maybe you have no claims in the past, so they're giving you a discount there. Some carriers will give you, if you belong to an association or a membership, they'll give you a club, a discount there. So it's really dependent upon which carrier that you're going to approach or get a quote from. but always ask about discounts. There's always, I feel like every policy that I've seen will offer it. Have you seen a carrier that not offer a discount?
No.
I mean, yeah, that's huge. But yeah, ask whenever you get that quote, definitely ask and find out what discounts are applicable.
Can you approve that? Cool. So we are on what number are we at?
We just did 3.
Okay. So just to show it real quick, Ryan already went over 1. Will the policy be adequate for a total or large loss? And then number 2 was what causes of loss are not covered. And then number 3 we just finished was the discounts and the available varying discounts that different carriers have. And then you're up for number 4.
Me?
Yeah, you're in a row. Keep going.
Let me take a drink of something because I just saw this the other day. It's it was Liquid Death. Have you heard of that?
It's a water. Yeah.
It's a water popular. In a can.
Yeah.
I mean, their slogan and all of their ads are just crazy.
Yep.
Let me see. What items are subject to limits or exclusions, and for which of these limits or exclusions should I consider adding coverage? What?
I like to approach this at sublimits. That's the biggest one. So everybody thinks that everything's covered, right? You know,
right.
I've got coverage A at 600,000, which is the dwelling, and then they don't understand that these carriers have sublimits for things like jewelry and silverware, which is crazy, but it's a little dated. But there's other things like camera equipment and I think some of them have drones now. No, not drone coverage. What was the other one? It was camera equipment was definitely one, and that was a big factor. It could be
that Hartford has a drone exclusion. I've seen
exclusion,
that
but not a sublimit, right?
Not a supplement. And that tying back into Fair Plan, a lot of people don't know that they don't cover your jewelry, your fine art. So
yeah, the Fair Plan is pretty straightforward. There's just a number of coverages that they do. You know, the dwelling, the other structures, personal property, right? Is that what we were talking about?
Yeah.
It's not a full typical homeowners insurance policy. It's a piece. It's a carve out.
Well, and a lot of those carriers too, they'll have just a full section of just maybe jewelry at $1,500, guns at $1,000, fine art at $1,000. Like they'll have that throw-in coverage, but you know, your Rolexes, your fine arts, your furs, all that stuff should usually be scheduled on like an inland marine policy.
Or scheduled. So let's go over scheduled because not a lot of people understand that.
Yeah.
That's where you're declaring the value and providing proof, either be it a receipt or an appraisal that shows the value of the thing in your home that could be stolen.
Correct.
Right? And then another thing to be generally understanding of is if you lost everything in a fire, right? If I took my phone and I walked around before the fire happened, I took a video of everything, then I can provide to the carrier and they can reimburse or they can pay for me to get new stuff. And those are the easier ones. The losses like theft, that's the harder one. That's the one where if you have a scheduled item, you've already provided either an appraisal or a payment receipt, then you can have that added. It's an extra action added to your homeowner's insurance, and that's covered if it's stolen.
Right. It's like a pool of money that they set aside, and they say, this is what we're going to set aside and make sure that we are paying for your lost or damaged item.
Yep. And then you did go over and sorry, I cut you off on that earlier, but
no, please cut me off.
So
yeah,
exclusions, definitely things like drones. There's a huge liability on that. So that could be a policy in of itself. One that's big for me here is we're seeing more and more kids on these e-bikes, and they're not your 10, 15 mile an hour e-bikes. They're your e-bikes that just rip, 30, 40 miles an hour.
Yeah.
And
I got them here too. There's like a gang of kids.
It's awesome. I love it.
Yeah.
Except, I want them to be safe. And we're talking from the insurance perspective. And I can almost blanket say that the homeowner policies that most people have don't provide any coverage for that.
Right. Yeah.
Next
And those
slide.
could usually be on your auto insurance or scheduled their own separate inland marine policy. Again, I feel like inland marine might be a term that will be new to you when shopping out insurance because of these exclusions and supplements that aren't on the policy.
Yeah, inland marine is a interesting term, but it's covering personal property in transit or that's not covered somewhere else in another policy. That's the basic way I guess I would explain that to a client. Would you explain it any different?
Inland marine is anything that's in the world. It usually says anywhere in the world while it's on land. That's why it's inland. Ocean marine is anything while it's out in the sea. So
got it.
Marines, inlands on.
I never have conversations about ocean marine, right? So
yeah.
Cool. Moving on to the next.
What is the next one? 5. Oh, how much can I save if I increase my deductible? Is there more than one deductible in the policy? Is the deductible waived if there's a large loss? So
great topic, actually. I'm glad we came up on this one because I'm putting eyes on this for the first time. So
it's a 3-parter.
Yeah, this is a great question. And what I'll say for those in what we call the concrete jungle, so not your higher wildfire areas, the deductibles that we were quoting in our agency were typically $1,000. And we no longer do that. Today, the average is $2,500. That's our floor deductible.
Mm-hmm.
And we'll do $1,000 if a client wants to, but the savings or the increase in premium just almost doesn't make sense. Everybody's risk profile is different.
Right.
In general, I would tell my client, I'd ask my clients and I'd ask the question, hey, would you file a claim if you had $1,000 window break with the knowledge that we're in the hardest insurance market that we've seen in over 32 years, or that California's been in over 32 years? Would you want that claim to affect your future rates or even the possibility of being non-renewed?
And the future rates thing, I feel like that's huge too, because whenever the carriers come back into the market, have you had a claim in the past 2 years, 3 years, and taking that 2,500 or even 5,000 is something that I've almost started to at least entertain, depending on the cost savings.
Whatever the client's risk profile is, absolutely.
Yeah, totally. That the risk profile, I guess, is the best way. Is can you afford is the $150? Let's just ballpark it. I mean, usually it's $150, maybe a couple $100 savings. Is that worth a $2,500 claim? And the thing is even if it is, you're probably not going to file a claim anyway because you don't want to be.
Correct. Yeah, right around that 2,500, 3,000 is where it makes sense for most people that they're going to use insurance. A phrase I like a lot that I talk to people is insurance is not to pay for maintenance. Insurance is for things that are sudden and unexpected. And usually those sudden and unexpected things are very expensive.
Yep.
And then so going to this question here, cost savings versus risk, what I see doesn't make sense to go to a higher deductible in general in the concrete jungle. Now, when you get out of the concrete jungle and you start talking about fair plan deductibles and things like that, I've seen some significant savings in going to a higher deductible for the California Fair Plan, right? So you've got whatever you want to call it, your supplemental, your WRAP, your DIC, that plan I keep for my clients right around, $1,000, $2,500. But then for the fire, because that's the main cause of the premium, main portion of the premium, I give them all the options. Primarily, I give them a 25, 5,000, 10,000, and 20,000, which is the maximum for the California Fair Plan. I give them a number saying this is at our default or suggested rate, which is $5,000 deductible for fire. And then on my quote, I say on the subsequent pages, there's more lower premiums at higher deductibles, and they have those options. So I'm seeing more and more people in the foothills. They're doing $10,000, $20,000 deductibles. And that's, I always caution them to that, because there is no distinction for the California Fair Plan in regards to the peril of fire. Kitchen fire, room fire, wildfire, it's all fire. So if you have a kitchen fire with a $20,000 deductible on the Fair Plan, you're coming out of pocket $20,000 before you get any insurance payment, right?
Yeah.
It's not as a big deal if you have a $700,000 house, $20,000 deductible, you completely lose it in a wildfire. That $20,000 isn't going to be that big of a difference. When you rebuild your home, you may rebuild it a couple's 100 square feet smaller or something like that, right? But the piece that we have to really consider and educate our clients on is the part about, what if it's just a room fire? Like you've got an extension cord I'm looking at right now, or a power strip, and that burns and that causes $10,000 in damage to the room, right? And you've got a $10,000 deductible. Well, then you're not getting anything from insurance,
right? And another thing too is, Fair Plan doesn't. It is a minus deductible, so subtracted from your claim payout. So that's why I think a lot of people do kind of take that $10,000 and $20,000 into consideration. But Fair Plan doesn't penalize you for claims either. So some people are like, well, I won't file a claim against Fair Plan, but that may bite you. Like we said, if the market corrects in the next couple of years, and now you've got a claim on your record.
And we don't have a crystal ball, so we're just going with the best information we have. Right?
I have a crystal ball. I keep the lottery numbers to myself in case of emergency.
Multiple deductibles. So we just went over some multiple deductibles. You've got two policies, right? The Fair Plan paired with another policy. There's two deductibles. Your typical homeowner's policy just by itself does not have a separate deductible or multiple deductible in general. And then you have E&S carriers, right? So E&S carriers, they can, because they're excess and surplus, they're not admitted carriers.
Yeah.
They can carve out specifics. So we do have carriers available to both Brian and I, where the deductible is $2,500 for all perils. And then there's a separate wildfire deductible. They're making a distinction between fire and wildfire. So kitchen fire, $2,500 deductible. Wildfire, then that's it could be a 1% deductible. And back to that $700,000 home, 1% of $700,000 is $7,000 deductible, right? So, yes.
Yeah, that's so that's Northlight does that. Delos does that. They'll have that split deductible, and a lot of, I think Delos just started. It's like 10,000, 25,000, 50,000.
Much higher deductibles.
Yeah, high deductibles. Yeah, it's crazy.
Which there is savings in premium, because a lot of people are looking at this, and I believe it's not sustainable. These rates are, they're a big factor. I talk to a lot of real estate agents, and I tell them, we do indication quotes because really you need that information. Sometimes those rates are almost like a second mortgage.
Right.
Next slide.
And that's why, chatting with an agent, I'm kind of on a love-hate with realtors, like with them saying, oh, give me all your quotes. And it's like, that's great, but I want to talk to the insured, because we're in that marketplace where we do need to fine-tune things, because a realtor they're going to get quotes from several of their agent friends, now you got to stand out. So,
well, that too is clients are only being given a number, not educated on what the coverage is. And I know you don't do it and I don't do it, but we have to talk to a client before we bind any policy. There's just no way around it.
Oh, yeah. Yeah, because there's so much things that you've got to go over. Definitely if it's with the Fair Plan and that supplemental policy, because it's risk adverse, like you'd said, and people want to go over those deductibles. But I think any policy nowadays, you need to talk to an agent. And that's kind of one of these questions is, what am I looking for? And you need to talk with your agent about it.
Yeah, absolutely. I'll move to the next slide now.
Well, was that 6? Question 6?
Yeah, we're on to 6.
All right. So
big question. What does coverage C mean?
Coverage C, what does that mean? Personal property for 100 or for 1,000.
So tell us about replacement costs or ACV.
So I've actually seen a lot of different changes with that too. Is replacement costs, and we've gone over this in another seminar. I think it was one of our earlier videos that we did, replacement cost. We had a whole kind of segment on replacement costs and actual cash value. So replacement costs, you're buying your brand new TV today. In 10 years, it's not worth the $500 that it was. So that's ACV, is the depreciation of that value. And then
ACV stands for?
ACV stands for actual cash value, and RC stands for replacement cost.
Yep.
So it's I guess if you're moving into a home, you're a brand new homeowner, and you have maybe $100,000 worth of items that you're buying as soon as you move into that house, you definitely want to make sure you've got replacement cost value on your property. But if you're what?
Without it being obvious or making it very obvious, which is better, RC or ACV?
Oh, RC. RC is way better. I think, even the cost savings doesn't really make sense to go with actual cash value as well.
On premium, you're talking about the savings on premium?
Yeah, savings on premium.
Gotcha.
Yeah, because a lot of the carriers will give you that distinguishable option that you can just check. Do you want to give them ACV or replacement cost value on their property and or even their dwelling too?
And one clear example to that is the California Fair Plan. Everything's a la carte, so you could select RC or ACV, correct? Yep. For personal property.
Yeah. And there's all those people that are moving into their home with hand-me-downs, and they don't, want maybe top dollar. They only want $100,000 or something for their property. And then, they do want actual cash value, but I tell people, your house burns down, maybe the town burnt down, and now you can't just go to the neighborhood thrift store. You've got to now go out and buy these items again. And, your $50 TV that you had 10 years ago now costs $250. So
maybe not the greatest example, because TVs are dirt cheap right now.
Yeah.
I was walking through Walmart, and it's crazy. You can get huge TVs for what you could be previously at like 32, 48 inches before. So, but it does make sense. All the things that you buy, furniture, chairs, etc., you want to be able to go out and buy them and replace them versus trying to find something cheap that you can afford, right?
Yeah, exactly.
And again, the cost and premium, it's not worth it. Not for the peace of mind you get. Cool. Moving to 7. Oops.
What are my options for insuring my home-based business, property, and operations?
Oof,
what are your options?
That's a rough one.
Yeah. What's your business? Is it an in-home daycare, which I had a call about today? That was interesting. Is it a pet sitting business? Are you just
purely online? And you don't have any clients come to your home. They never know where you are. And you drop shipping, so you don't even have product in your home, right?
Yep. I would say
those are completely across the spectrum, different risks.
Right. Yeah. You definitely want to make sure that your carrier allows for in-home businesses, which some do, some don't. And then what's the foot traffic? That's, I think, one of the largest determinations on whether or not you're going to be eligible for a home insurance policy is, do you have clients coming to your home? Because that's increased liability.
Absolutely.
And that's increased liability that you don't want to take on.
So how do we spell that out? So like increased liability for foot traffic is an easy example. So that's where that wrinkle is. Sorry. But spelling out so that people understand what increased liability is for that. So if you're a homeowner and you're at home, generally you have guests come over and that's your extent of liability. But if you're running a business from there and someone knows that you're a profitable business and they want to do something, they could say, oh, I tripped and I fell, and they want to sue. There's increased risk for that, right? You still get sued by a friend who comes over and trips and falls, but that's already built into the premium for a homeowner's policy. What we're talking about is adding a business onto that in your home and how much that increases the risk. And that's why some carriers will do it with an endorsement. Some carriers won't. None of them will just flat out let you do it. If you have a homeowner policy and then you start a home business and you don't disclose that, I would think, and I'm not licensed for claims, but I would think that if you filed a claim or someone sued you for that, it would be denied.
Yeah. Yeah. Giving a carrier an opportunity to deny your claim, watch out.
Yeah.
Yeah. Anytime you want to put the ball back in the court of the insurance company, a lot of the times that they're going to pay, I would say, I don't know. I guess I'm not a claims adjuster either. So I haven't seen a multitude of in-home kind of daycare businesses or in-home businesses claim situations. But in theory and stories that I've heard that they will pay, they just maybe will non-renew you. But there is still that it's a gray area,
Mm-hmm.
And do you want to go to the court and try and fight your claim? Yeah,
is it worth the headache, right?
Yeah. Yeah.
And to be clear, Ryan and I are licensed insurance agents. We're licensed for property and casualty. There is a very separate distinction in California to be licensed as a claim adjuster. So
Oh my gosh.
we're just giving broad concepts here. This is not to be taken as actionable legal advice because we don't have those licenses. We don't live in that space.
Exactly. Yeah. Just from stories we've heard from hanging out by the water cooler.
Yeah. Moving on to 8 here.
Let me see.
We already touched on this a little bit.
Yeah, we did. Well, yeah, because it's about enough coverage in place for your electronics, piano, jewelry, fine art, rugs. I
got a good example for this one. So I had a client and they had a $30,000 painting and they provided me with an appraisal for the painting and we scheduled it. And it costed $30,000 in coverage for the painting, costed $23 for the year.
Right.
And it gave her the peace of mind that that was not covered.
And did it say in the policy that it would still do $1,500 for fine art or jewelry? Like, was it?
I don't remember. Yeah, that wasn't her primary concern. So it wasn't a question. I didn't go look back at it, but yeah. I did know that was her number one thing she wanted covered. And scheduling, although sounds like a lot of work, which there is extra steps, but it's definitely more for peace of mind and the premium associated in general. I had another one with a $32,000 ring and we scheduled that and that was still less than $70.
Yeah. And I guess another thing, it's a two-way street. We definitely ask a lot of questions to make sure that we're gathering as much information as possible. But a lot of people, maybe they go out and get married 5 years later or 3 years later, or they buy a new watch. We aren't mind readers and we can't understand kind of what you have going on all the time. So anytime that you make a new purchase, definitely call your insurance agent, and just say, hey, is this covered? Is this not? Because we can quickly run through the documents of your insurance policy and see if it's covered or not, and if it needs to be scheduled on.
Absolutely.
So, all
right, moving on to 9. Wow, we're filling this hour pretty fast.
Yeah, these were good stuff. See you, Rob. For how long will my temporary rent and related expenses be covered while my home is being repaired or rebuilt after a loss? Is there a total dollar cap, monthly cap, or time limit on the coverage? Do you offer 2 years of additional living expenses? Another 3-parter.
So what you're reading and what I copied is a little bit different. It's all related, but
yeah,
definitely the ALE. You already went over that, and you were.
What coverage is that? What coverage letter?
Loss of use. So that's D.
All right, for $1,000.
I'm put on the spot. Normally, I'm looking at a document. I can tell you. Now I got to work off of memory. I don't know. But yeah, you did go over what the ALE stands for. So I'll go over the second bullet point first, and we'll work from bottom to top. The importance of having at least 24 months or 2 years of, and what was ALE again?
Actual loss, additional living expenses.
Yep.
Oh, it's right here. Sorry.
That's why I was asking.
You caught me off guard. I was not looking at your slide.
So yeah, you can work on the first bullet point: duration limits, monthly caps, and total caps. What does that look like?
Yeah, I guess it really is dependent on your policy as well. I mean, and that's the thing. Everything's policy dependent. Generally, it's going to be 12 months, up to 12 months. Some I've seen of 24 months. There's a 24-month option. So
some carriers treat it by months. Other carriers treat it by a dollar amount, right?
Yep. Well, it's like both.
Either or.
Yeah, some carriers are either or. It's like up to 12 months or the extensive amount of whatever your coverage is. Because if you've got, say, 50,000 for your coverage D, and then there's 12 months, well, which one's going to run out first?
Right. And what I see from the carriers in general is coverage D is a formula. So you've got your calculator, your replacement cost estimate calculator to determine coverage A, which is your dwelling. Mm-hmm. And then all the other coverages, B, C, D, not all the other, but B, C, and D, those are a formula default off of coverage A.
Yep.
For a majority of them. And typically coverage B, which is personal property,
personal property.
B, personal property, which is 50%. I see a lot of my carriers. Coverage C, which is other structures, is 10%. And coverage D, loss of use, or what we're talking about right now, is typically 20%. So if you have that 700,000, I can't do math in my head. Let me pull up the calculator real quick. So your default for a lot of the carriers I use at $700,000 home is $140,000.
Yep.
And to personalize this, so if you think about it this way, $140,000, you think your average mortgage or what it would cost you to live in a comparable place to your home while it's not occupiable. Let's say that's $4,000. No, let's say $3,500, right? So we take $140,000 divided by $3,500 a month. That's 40 months of ALE. Mm-hmm. So, and again, I'm just giving you what I see as a default for coverage D that's calculated by the carriers and making it real for people. So you could see that in general, 20% I think would be pretty reasonable for $3,500 to live someplace else. Now, if you're renting something short term and you're not paying for your mortgage, then it's probably going to be higher. So even if we went at 40,000 or 4,000, that's still 35 months of living expenses.
Yeah. So I do have a personal experience. My in-laws, their house burned down in a nearby town, and it was just one house, not a huge fire or anything. That was like a wildfire or anything. And they were out for almost 2 years. So between
to rebuild and be able to live in their home again, or
rebuild the whole entire home.
Built it from the ground up.
Yeah, from the ground up. So there's debris removal. There's county permits you got to get. All the hoops of finding contractors. I mean, there's just so much that goes into building a new house. So that's just 2 years, which was just mind-boggling. I mean, you look at the campfire people, that was almost 5 years. Mm-hmm. So that I'm always that coverage is always kind of near and dear because I have a personal experience with it with my in-laws. And, I always try and say you want to at least that coverage I feel like is not as detrimental to your premium. Mm-hmm. And with a lot of the wildfires, especially here in California, being out of your home for maybe even just evacuated could take a week, depending on, the extent of the damage that happens.
Sure. So, and then you're talking about hotels, which
So I mean, there's a lot of things that you may not think about that go into it, from being evacuated from home to your total loss and how long are you going to be out for. So. Mm-hmm. Increase the coverage, I would feel like as max as possible, because that's just me. I always give that scenario, like here's your 10% and here's your 30% or whatever the max is you can do. So that's me. That's my grandstand. Was there more? There's more to that, right?
That was it on this slide. So number 9, I'm moving on to number 10 now.
I almost feel like this is going back to the business thing, but if someone sues me, will my liability pay for legal fees?
Yeah, it's a great question. And that really is what liability is, right?
Yep.
Liability is to protect you against being sued, whether it be for a legitimate purpose or not. I mean, I've heard some horror stories where someone's in another person's house, there's a glass table, they trip over the dog, hit the glass table, shatter it, have a whole bunch of surgery that's needed. One eye goes, or they lose sight in one eye. And, that reasonably, I can think that could happen. I mean, I'm generally clumsy. If I trip and fall, it could be a big issue, all depending, right?
Yeah. And you can ask your agent if it's going to pay for the legal fees. You can ask them if it's inside the limits or outside the limits.
Yep.
That's
very key words.
Like the inland marine and ocean marine. Just say, the legal fee is going to be paid with this policy. Look for inside the limits. I guess the only caveat is
what legal fees are, right? So legal fees are the cost to defend, right? That's your attorney fees, that's your documents, everything. That is separate from, if you think about a lawsuit, a judgment. A judgment is where if somebody's suing you for $250,000, the judge finds in that person's favor. Now you're on the hook for $250,000, and that doesn't account for what you paid for your attorney to defend you.
Yeah.
So just want to clarify that.
and outside the fees is what's preferred. You don't want to erode your $1 million limit with paying legal fees could be 100,000, 200,000. So now you're eroding your liability limit of 500,000 just for paying legal fees. You may not even get to whatever the actual cost is of the damage. So you want to make sure that all of your legal fees are outside the limits, if possible.
Cool. Moving to 11.
Yeah. Oh,
This is a great question. I talk about this almost every single day.
Oh, well, let's let you answer every single day. Have you answered it yet?
So majority of the carriers that we write, or I write, their maximum liability limit is either $500,000 or $1 million. And that's for homeowners specifically, not the auto. In auto, we're seeing generally maximum of 250 or 300,000 per incident, and then per person, and then a maximum of usually $500,000 per incident. And there's some auto carriers that'll do $1 million. I know there's a couple of the admitteds that are still doing $1 million, and that really can be run through very, very quickly. If you think about an accident where people are seriously hurt or somebody loses their life, you're already going to hit the caps. For home, like I said, we're seeing $500,000 to $1 million, and then we have the conversation quite frequently about umbrella. So umbrella, there's underlying coverages. So like some carriers, as an easy example, they don't care what the underlying coverage is if they're the carrier writing the underlying coverage. So if your homeowners is through carrier A and your umbrella is through carrier A, they may not care because they're covering that for the whole thing. I've seen limits as low as 100,000 for their homeowners liability, yet that carrier is still offering a 1 million or 2 million umbrella, it was mind blowing to me when I saw it. In general, though, you're going to want to have the maximum underlying limit, so $500,000, and then you get an umbrella on top of that to protect you further. This is, really what you want to do is you want to have enough insurance to cover you up to your assets. So if you have, a lot of money, you're going to have even higher umbrellas because you're trying to protect that from being lost in a lawsuit.
Right.
I think I went over those 3 bullet points really quickly with that. Is there something you wanted to add to it?
And I was just going to say, that umbrella carrier, they're going to require you to have underlying limits set at specific limits too. So
if it's a separate standalone umbrella.
Yeah. And I guess the way that it works is, say you're sued for $3 million, your homeowners is going to cover the first 500 or $1 million or whatever limit it's at. And then after that, it goes to your umbrella. So yes, make sure it's covering your net assets, your net worth. Even if you've got real estate in different LLCs or different names, always just make sure that you're not going to come out of pocket for any kind of lawsuit, because we're in California.
And I would say in general, umbrella coverage is very affordable. I mean, very affordable.
I would say I've seen like 3 million be like less than $1,000 a year.
Mm-hmm. Yep.
But it's also dependent on maybe your driving record.
Or claims.
Yeah,
Yep.
claim maybe how much, what your liability is to that umbrella carrier. So, yeah.
Moving on to 12. Sorry, I couldn't make the slide with the orange.
Yeah. What if construction costs spike after disaster? Called a what? Do you know?
What's that?
Do you know what it's called?
You're talking about ERC, but I don't know exactly the word you're thinking.
So demand surge.
Demand surge, yeah.
Yeah.
That makes sense.
The demand has skyrocketed. I mean, lumber costs are through the roof, or maybe they're leveling out now, but they used to be a lot more.
Well, let's personalize it, right? Like your in-laws. It was your in-laws?
Yeah.
That was one house. So you don't expect demand surge. But if you're in Auburn and 20 houses burned down, all of a sudden, all these houses need to be rebuilt in that subdivision. That's going to create that demand surge you're talking about, where it's that perfect, supply and demand piece. So
yeah, which
things may go up a certain amount.
And I wish I had the figure in front of me, but I remember that like the Department of Insurance or Ricardo Lara, he was like, there was some law that he put into place about limiting the demand surge and not letting contractors charge more.
Well, then you get into gouging, right? So there's a
Yeah.
difference between gouging and demand surge.
But no, I mean, that's what he did. It's like you can't really account for what the demand surge is, and an insured doesn't know that either. So,
neither do we, to be clear.
Yeah, neither do we. But yeah, that's the thing and that's why you want to guest talk with your local agent. They're going to know what the building cost is for their area. If someone asked me to write a home down in, I would say LA. I don't write frequently down in LA. I don't know what the building costs are. I can.
For as an example, East Bay. Like East Bay could be double what we're writing here in the greater Sacramento area. Very, very easily, because labor costs there are higher.
So I guess that's another reason why you want to choose a local agent that's going to know what the rebuilding costs are and maybe what they could jump up to. And that's why you want to add on what I think you were talking about earlier, the ERC, right? And which is
extended replacement costs. So that's that second bullet point. Do you know a carrier that's writing guaranteed?
I knew of a carrier in my history of writing insurance.
I don't have a carrier that's writing guaranteed.
No.
So
no. I mean, it's funny that it actually is a bullet point. I maybe at one point in time the Fair Plan did, but
or maybe I'm understanding that bullet point, right? So, but yeah, everything we write with
you're understanding it right. Yeah, there used to be a guaranteed replacement cost.
Well, I know in other states there's carriers that are guaranteed replacement up to $2 million blanket, regardless of the policy. So,
well, it's probably because it's using ISO, which is Insurance Standard Offices or Services Office. So that's just a standardized form that's used industry wide. So guaranteed replacement. I mean, that same special coverage form is used across the nation.
For the great majority of our carriers now, I know we're writing extended replacement costs of at least 25 to 50%.
Yep.
So that way it accounts for that demand surge.
Yeah.
What's the third bullet point? What policies actually adjust for post-disaster inflation? I think we're talking about ERC, no?
I think that's what it sounds like. What policies?
Yeah, I'm going to skip that one because I don't really understand that one.
We'll skip it.
So let's go to, I have a mistake. I have 11 on 12. Sorry about that. So we'll go on to 13.
13. Will my insurance cover the cost to upgrade electrical, plumbing, and other building code upgrades if I have to make repairs or rebuild my home?
This is a great one. Super easy to give examples on and personalize it for people. So homes built in the 90s, we know that they didn't require solar to be built. Or as another example, didn't require interior sprinklers. And those are things that are looked for now, absolutely in new construction. And we know solar is going to help people save money. And we know that interior sprinklers are going to help save lives. So like My home was built in 2000. I'm in my home office right now, and I'm looking around. I have no interior sprinklers, so it's I don't get that discount. But if I buy a new home that has interior sprinklers, there's an additional discount for that. These are code upgrades or requirements by, it's called ordinance or law, and there's specifically reason why ordinance is capitalized and law is capitalized, because it could be either or. It's not ordinance of law. A lot of people mistake that.
Wow, so I've never heard that before.
I get it a lot. So ordinance could be a city ordinance, a locality ordinance, a county ordinance, right? And then law is law. So whatever the reason for the code, and for us, a lot of that knob and tube wiring, as an example, is Zinsco panels. They're still coming up. People are buying homes with Zinsco panels, and I have 0 carriers that will write a home with a Zinsco panel. And every carrier does an inspection, and I get it back. I've had probably 4 in the last 2 months that had Zinsco panels. And the buyer didn't know it, but it was brought to their attention, and every single one of them, these were in Sacramento County. SMUD's been very proactive on that. Every single one of them replaced the panels to keep their insurance policy. They understood the importance of that. But that is where code had changed, because at some point in the 80s, 70s, 80s, 90s, I think it was, early 90s, Zinsco was using a lot of construction. And now no one uses Zinsco whatsoever. You want to add to that question? Or
no, you did great. That was amazing.
That was easy. That was very easy. Oh,
and I learned something. I didn't know the ordinance of law. That I've never heard it called that before.
I hear it a lot. Yeah. The other piece to this is the formula in which carriers typically add coverage. This is another formula piece, and ordinance of law is typically at 10% from what I see from my carriers. So if your home's 700,000, 10% is 70,000. Your home burns down. It was built in the 80s. And it burned down. Today you have to rebuild it to code. You have to have different wiring, different plumbing. Pretty sure it's different plumbing as well. And you're required to have solar, and that 70,000 goes towards paying for the solar. So your home, as it sits today, and your home after it's been rebuilt, is actually going to be better to some degree because of this coverage.
Yeah.
Actually, not even some degree.
And you're not going to erode. And you're not going to erode your dwelling coverage because you've got another pool of money to pull from.
Correct. All right, last slide here.
Are there limits in this policy on replacing property if there's such a need to match, or damage is considered cosmetic only? Oh,
I don't get this a lot, and I know the slide's a little small, but
yeah.
Do you ever have conversations with people about this?
I haven't. No.
I don't see that happening quite a bit in California.
Yeah.
Like some places they have like hail damage, and instead of replacing the whole roof, they'll replace portions of the roof.
Yeah.
And so you'll have the color variations or things that are more cosmetic versus actual safety or viability of the product. And some of them have it, some of them don't. I don't feel this question at all. So I don't have an example to give here.
Yep, I don't have anything on that.
Cool. So that's the 14 questions. I'm going to bring back house calls, and we've got 6 minutes left. That's pretty good for us today.
Yeah.
It's one moment here.
I guess I didn't have any questions on my channel. I know that I mentioned to you that I posted it in that other group, and they had a few questions. Let me pull up that group again too. We can go over them.
You want to approve that house call slide?
Approved.
Cool.
Let me see. If you want to check your Facebook page and see if anyone posted anything, I'll check this group real quick.
Cool. Just give me one moment.
So, oh my gosh, there's a lot more questions that popped up.
Oh no. Well, we will address those next week and save them. So,
someone asked about opting out of Zone 0.
Right now, that's not a thing. It's not a requirement, but I think politically that is coming, right?
Yeah.
I think that's gotten the most push is Zone 0.
Yeah.
I could be wrong. I haven't looked recently, but I do see it being discussed quite a bit. I have no questions on Facebook, and going to YouTube, I do not see any questions on YouTube either.
Okay.
Cool.
Any recent news that we want to go over?
Yeah, for auto insurance, I got to tell you, I'm having conversations with clients, and
Okay.
Costco.
There you are talking to clients again, Chris.
I'm having conversations all day, but I gotta say, your average auto insurance works out to, with clean record. What I'm seeing is, and we don't write a lot of auto, so the disclaimer there, but we do write auto, and your average rates from what I see publicly, what I have conversations with, and with our current clients, you're looking in California with a clean record, one driver, one car, about $150 to $245 a month is what we're seeing the range of auto insurance.
Wow.
And I've heard from two different clients this week and last week that they went to Costco. Costco Connect is writing again auto insurance through AmFam, American Family, and their rates, they sent me the quotes and the deck pages, and their rates are absolutely killer. Definitely under the average of $150 a month.
That's crazy. That is nuts.
And that's new, because I know I could tell you 30 days ago I didn't have anything like that. I never came up against it.
Yeah. I'm wondering in that, and that's where you can go back, and see the filings is maybe they finally got all their rates approved and they're like, let's re-enter the market, and then start charging at that time.
It could be, yeah. You do that a lot better than I do. I think we should look at that and see what happened, but they were closed for a long time. Costco Connect was not writing for a long time, and now they are, according to these two clients I spoke to. I myself haven't gone there. They're captive. We're not allowed to go there. We don't have access to it, but I could still quote my own to see how competitive that would be. It's another option for people to look into.
I mean, that's just another thing, kind of the premise of this. And I feel like a lot of us agents have all talked to each other. It's like, kind of just show us what you have and what you've been given. Like, not only does it help like us understand kind of like things that we aren't appointed with, but a lot of times a good agent like me and Chris, like we're going to tell other people, go here. Like this, I feel like this whole environment in the past 5 years has really helped me feel better about navigating people on what the best course is to take, because, I sat in on a DOI where the commissioner came out and he's like, oh, there's hundreds of carriers out there.
Oh, there is.
And it's like, but there's not, like, they're out there, but they're not writing. Like, you're just sending people on a wild goose chase. And, you there's got to be some sort of person out there helping navigate.
Well, that's what we want to do, right? We want to provide value to clients, because I know what I have. I know to some degree what carriers you have.
Yep.
And there's no way we can have it all. And there's no way we can serve everybody. There's going to be options out there, and we want to just help navigate that for people.
Yeah. Fantastic. Thanks,
cool,
Chris.
Well, I think we got a minute left. We can cut it a minute early, and we'll queue those questions up for next week, and we can answer those questions next week.
Oh, they're doozies. They're really good questions too.
Fun.
Yeah.
Awesome. You want to end the live?
Yep, we'll do. Thanks everyone for tuning in, and we look forward to seeing you next week.